You need to pay attention right now, because last week silver didn't just fall, it collapsed. We're talking about roughly 37% wiped out in days, with Western prices dropping from around $121 an ounce to the mid-80s. That's not a slow bleed, that's an air pocket. And here's the part most headlines are missing. While silver was crashing in New York and London, prices in Shanghai barely moved, holding near $122. That's a 40+% physical premium. Both Western futures desks and Asian physical markets just confirmed something is stressed, not broken. Stay with me, because I'm going to show you what actually caused this, what to watch this week, and how you can spot this pattern before the next one hits. Before I explain what caused this move, let me teach you something most people don't understand about silver. Silver doesn't trade like gold, and it definitely doesn't trade like stocks. Silver lives in two worlds at once. One is the physical world, bars, coins, industrial demand. The other is the paper world, futures contracts, leverage, margin. Most of the time, those two worlds stay loosely connected. But when leverage builds too fast, silver behaves like a coiled spring. Think of it like a crowded elevator where everyone borrowed money to get in. When the cable snaps, it's not because the building disappeared, it's because too many people were leaning on borrowed weight. That's why silver rallies are violent, and why silver crashes are even more violent. You're not watching supply and demand change overnight, you're watching leverage unwind. Now here's what makes this critical for you to understand. When you see silver move 10 or 15% in a day, your first instinct is probably to think something fundamental changed. Maybe industrial demand collapsed, maybe a mine flooded the market. But that's not how this works. Physical silver moves slow. It's heavy. It's expensive to store and ship. Industrial users don't just flip a switch and stop buying. Jewelry demand doesn't vanish in 48 hours. So when price moves that violently, that quickly, you're not seeing the physical market react. You're seeing the paper market panic. And this matters because most silver trading happens on paper. Futures contracts, options, ETFs. For every ounce of physical silver that actually exists, there are dozens of paper claims on that silver. Think about that. It's like a poker game where everyone's betting chips, but there aren't enough chips in the casino vault to cover all the bets if everyone tried to cash out at once. As long as people are just trading chips back and forth, it works fine. But when someone demands actual chips, when physical delivery gets requested, that's when you find out who's been playing with borrowed chips. If this is making sense, drop a comment below and let me know if you've been watching silver or if this is new territory for you. Because what I'm about to show you next is the exact mechanical sequence that caused this crash, and once you see it, you'll recognize it every single time it happens again. Now here's what's actually happening. Let me break down the sequence. Silver had gone parabolic. Not healthy, steady buying, vertical price action. That attracts short-term traders, hedge funds, and leveraged players piling into futures. These aren't long-term investors buying bars for their safe. These are momentum chasers, using borrowed money to amplify returns. And here's the thing about leverage. It works beautifully on the way up. If you control 10,000 ounces of silver with only $2,000 of your own money, and silver goes up 10%, you just made massive returns on your actual cash. But leverage cuts both ways. Then volatility spikes. This is the trigger. When markets get choppy, when price swings get wider, exchanges raise margin requirements. That means if you were controlling 10,000 ounces with $2,000 yesterday, today you might need $4,000 to hold that same position. Suddenly, traders need cash, so when price starts slipping, forced selling kicks in. That selling pushes price lower, which triggers more margin calls, which forces more selling. It's a cascade. Picture dominoes, but each domino that falls knocks over 3 more dominoes. That's the feedback loop. The primary driver wasn't new supply. It wasn't collapsing industrial demand. It was paper market deleveraging. You're watching traders who borrowed money to buy silver futures get forced out of their positions because they can't meet the new cash requirements. They don't want to sell. They have to sell. And when you have to sell, you take whatever price the market gives you. You're not negotiating. You're liquidating. Now here's the secondary confirmation, and this is where it gets really interesting. The Shanghai market refused to follow the crash. Physical silver stayed bid. Premiums exploded. While New York was trading silver at $85, Shanghai was still near $122. That's not a small difference. That's a 40% gap. And what does that tell you? It tells you the physical market, where actual silver changes hands, where industrial users are buying real metal for real production. That market didn't panic. That market held firm. This is the divergence that matters. When paper collapses but physical holds, that divergence tells you stress is inside the financial plumbing, not in the underlying asset. It's like watching the stock price of a company crash while customers are still lining up around the block to buy their product. The disconnect tells you something broke in the pricing mechanism, not in the business itself. And convergence is where it gets interesting. These two markets, paper and physical, they can't stay disconnected forever. Eventually, they have to reconcile. Either physical prices drop to meet paper, which means real buyers in Shanghai stop bidding and actual industrial demand collapses, or paper prices rise back toward physical, which means forced selling exhausts itself and futures markets stabilize. History shows us which one usually happens. But here's the part that should make you nervous. If forced selling isn't done, price discovery can overshoot. Silver doesn't politely stop at fair value. It falls until sellers are exhausted. Let me show you what I mean. When margin calls hit and traders are forced to liquidate, they're not running spreadsheets calculating intrinsic value. They're just selling. And the market doesn't care about your cost basis or what silver should be worth. The market clears at whatever price brings in enough buyers to absorb the selling. Sometimes that price is way below any rational fundamental valuation, but markets can stay irrational longer than you can stay solvent, as the old saying goes. And that's the danger zone we might still be in. This is the exact same playbook silver has run before. In 2008, silver fell over 50% in months during the liquidity crunch, only to rebound violently once forced selling ended. I remember watching that. Physical dealers couldn't keep coins in stock. Premiums were going crazy. But futures prices kept falling because funds needed cash, and silver was what they could sell. Then, once the liquidation wave passed, once sellers were exhausted, silver bounced back hard. The physical buyers who'd been waiting on the sidelines stepped in, and prices recovered most of that drop within a year. In 2011, after silver spiked near $50, it crashed over 30% in days when margins were raised. The CME, that's the Chicago Mercantile Exchange where silver futures trade, they raised margin requirements 5 times in 9 days. 5 times. Every time they raised margins, more traders got forced out. More selling hit the market. Price collapsed. Then it chopped violently for months while the market digested what had happened. But the interesting part is what came after. Silver eventually found a floor, stabilized, and even though it didn't get back to 50, it held value way above where the crash bottomed. In March 2020, silver collapsed alongside everything else, even as physical demand surged and premiums exploded. You couldn't buy silver coins anywhere. Dealers were sold out. The U.S. Mint suspended production because they couldn't keep up with demand. But futures prices? They crashed. Why? Because hedge funds and institutions were getting margin calls on their stock positions, on their bond positions, on everything. And when you need cash fast, you sell what you can, not what you want to. Silver was liquid enough to sell, so they sold it. Physical buyers were screaming for metal while paper prices collapsed. Same pattern, same divergence. Every time this happens, people argue fundamentals. They say, silver's going to zero, or silver's going to the moon, based on whatever narrative fits their position. But zoom out, and you see the pattern. When leverage unwinds, price disconnects from reality temporarily. It always reconnects. Always. But the path and the timing, that's what's uncertain. And the larger story is that silver's role as a monetary and industrial asset doesn't vanish just because futures traders blew themselves up. The industrial demand is still there. The jewelry fabrication is still there. The investment demand from people who want physical metal, that's still there. What vanished was the speculative froth, the borrowed money chasing momentum. Now, let me be skeptical for a moment, because I want you to hear independent thinking, not just hype. Could this keep going lower? Yes. Anyone telling you crashes can't continue is lying to you. If liquidation resumes, if funds are still forced sellers, you could see $70 to $75. That's the deep washout zone where even banks like JP Morgan start talking about $50 risk scenarios in their client notes. I've seen those reports. They hedge everything, but when major banks start putting out downside targets that extreme, it means someone's worried about tail risk. Could industrial demand actually weaken and justify lower prices? Yes. If we hit a global recession and manufacturing slows, silver demand drops. Solar panels use silver. Electronics use silver. If those industries contract, that's real fundamental weakness. And let me be honest, manipulation narratives don't help you here. I know people love talking about how silver markets are rigged, how big banks are suppressing prices. Maybe they are, maybe they're not. Here's the thing. It doesn't actually matter whether markets are fair or not when it comes to your account balance. Complaining about manipulation doesn't protect your capital. Focus on what you can control: levels, volatility, and confirmation. What you can control is where you enter, where you exit, and how much risk you're taking. You can control whether you're buying physical metal that you hold in your hand versus paper contracts that can evaporate. You can control whether you're using leverage or not. Those are your decisions. The rest is noise. So instead of getting caught up in who's doing what behind the scenes, watch the price action. Watch the volume. Watch the divergences between markets. That's your edge. There are probably 3 types of people watching this right now. If you're long-term and you already hold physical silver, you're probably stressed but not panicking. You bought metal because you believe in its long-term value. You're not leveraged. You're not getting margin calls. For you, the question isn't price today. It's whether physical demand stays intact. And here's what I'd tell you. Watch Shanghai. Watch the Shanghai Futures Exchange. As long as prices there stay above roughly $115, the physical story isn't breaking. As long as premiums stay elevated in Asia, as long as dealers can't keep coins in stock, the underlying demand is still there. Your time horizon is measured in years, not days. This kind of volatility is painful to watch, but it's not fatal to your thesis unless the physical market actually cracks. And so far, it hasn't. If you're a trader, this is dangerous territory. You don't catch falling knives. I don't care how good the setup looks or how oversold the indicators are. When volatility is this extreme, when forced selling might still be active, you wait. You wait for volatility to cool. You wait for price to hold key levels like 80 to 85. You wait for a consolidation pattern that shows sellers are exhausted and buyers are stepping in. Trying to pick the exact bottom is how traders blow up their accounts. Let someone else catch the falling knife. You wait for confirmation that the knife hit the ground and stopped bouncing. And if you're on the sidelines, feeling like you missed the move, understand this. Silver gives multiple chances. This isn't a one-time opportunity that disappears forever. Silver cycles. It always has. If this bottoms and rebounds, there'll be another entry. If it drops further, there'll be a better entry. Patience beats prediction every time. The worst thing you can do is feel FOMO, feel like you have to act right now, and jump into a market that's still in free fall. Wait for clarity. Wait for structure. The opportunity cost of waiting is way lower than the actual cost of being wrong in a volatile market. The universal rule for all of you is the same. Don't react to headlines. React to structure. Headlines tell you what happened. Structure tells you what's likely to happen next. And right now, the structure is unstable. We're in that zone where anything can happen because forced selling creates unpredictable price action. So you wait, you watch, and you prepare. So here's where I stand. I'm not all in buying the dip, and I'm not panic selling. I'm watching. Let me tell you what I'm personally watching. First, I'm watching whether 80 to 85 holds in the West. If futures prices in New York stabilize above 85 and hold for a few days without making new lows, that suggests forced selling is done. If we break below 80 and keep going, that suggests there's another leg down coming, and I'm staying on the sidelines until we find a real floor. Second, I'm watching whether Shanghai premiums stay elevated instead of collapsing. If that 40% premium starts shrinking fast, if Shanghai prices drop toward Western prices, that means physical demand is weakening. That's a red flag. But if premiums stay wide, if Asian buyers keep bidding aggressively for physical metal even while paper crashes, that confirms the thesis that this is a paper market problem, not a silver problem. Third, I'm watching volatility. When volatility cools, forced selling is usually done. I'm looking at the VIX for silver, looking at implied volatility in the options market. When that starts coming down, when the wild swings start narrowing, that's when you know the panic phase is ending and we're moving into a consolidation phase. That's when opportunities start appearing for people with patience. Based on my analysis, this crash was mechanical, not emotional. The fundamentals didn't vanish overnight. Industrial demand didn't disappear. Solar panel manufacturers didn't stop buying silver for their production. Electronics companies didn't suddenly find a substitute. What happened is traders who borrowed money to chase a rally got squeezed out when volatility spiked and margins increased. That's a technical event, not a fundamental shift. If history rhymes and silver stabilizes here or takes one more flush lower before finding support, the move that follows could be just as violent on the upside as this crash was on the downside. I'm not predicting it. I'm not saying it's guaranteed. I'm saying the pattern suggests that when forced selling exhausts itself, when all the weak hands have been shaken out, the snapback can be aggressive because physical demand doesn't go away and supply doesn't magically increase. But timing that is the hard part, and I'd rather be late to a move than early to a continued collapse. I'm not a financial advisor. This is not financial advice. Do your own research. Verify everything I've said. Check the Shanghai prices yourself. Look at the historical precedents yourself. Make your own decisions based on your own risk tolerance and your own financial situation. What I'm giving you here is a framework for how to watch and analyze these moves, not a prescription for what to do with your money. If you made it this far, you're not looking for quick tips or hot takes. You're looking to actually understand how markets work. That mentality will serve you well. Most people won't sit through a deep dive like this. They want someone to tell them buy or sell, up or down. But markets don't reward that kind of thinking. Markets reward people who understand structure, who can read between the headlines, who can spot the difference between mechanical selling and fundamental breakdown. So if you found value in this, share it with someone who's trying to make sense of what just happened. Subscribe if you want more analysis like this, and stay ahead of the noise. There's going to be a lot of noise this week, a lot of hot takes, a lot of panic, a lot of hype. Your job is to filter that out and focus on what actually matters. Watch the levels I mentioned. Watch the premiums. Watch the volatility. Let the market show you what it's doing instead of trying to predict what it should do. Think critically. Verify the data and make your own decisions. Stay sharp out there.